A very good afternoon, everyone. This is Saby, your trusted tax advisor. Um, I am live today to discuss the federal budget uh, 2026. And what is important today is that there are a lot of things I'm going to discuss live today. Today is 15th of May. It's 12 noon from Melbourne. This is Saby, your trusted tax advisor. So, as you probably would have seen or heard by now, there is a lot of information out there about how it's going to impact you as an individual or a property investor or even just a generic investment who may have invested on shares, EFTs, and many other things. It is important to note, first of all, is that these changes or the tax law reforms are still law reforms. They haven't received a royal assent. Royal assent means that it has officially become a law. But having said that, majority of the time they will receive a royal assent, and therefore you will um, get this in a form of law in the near future. So, what are the things which we're going to discuss, or I'm going to discuss about is that whether you think this budget is good for you or not, irrespective of that, well, the budget tax reform measures has been announced. What we need to look at is not about the problems, it's more about the solutions now we need to look at. It may impact you, it may not impact you. But overall, the sentiments of the budget announcement by the government was essentially more towards supporting the young generation. We've been hearing a lot in last couple of years that youngsters, young Aussies are not able to afford home or perhaps say a first home buyer, a home for themselves and for their family in Australia. Now, whether this is a low hanging fruit for the government to leverage on and actually implemented all these significant law reform changes, which I'm going to discuss with you. Now, on 12th of May 2026, the Treasurer handed down the federal budget. And as in previous years, the tax is important component here. This year budget was delivered against a complex economic backdrop characterized by persistent cost of living pressures, elevated interest rates, subdued productivity growth, and continuing physical constraints. Price pressures remain and look to continue to rise amid the ongoing fuel crisis stemming from the war in the Middle East. At the same time, businesses' confidence remain unsteady and the government finances are under ongoing pressure, with deficits forecast to persist and eye-watering debt levels. Never happened in Australia before. In this environment, the government has sought to balance target relief for some with increased taxes on investments, while positioning tax reform as a part of the broader strategy to support long-term revenue sustainability. Now, what are the key tax measures? There were a number of measures introduced in this budget which materially reshape aspects of tax system, particularly in relation to capital, investment, business taxation. These measures reflect a policy focus on housing supply, cost of living relief, and revenue sustainability for the government, alongside targeting support for the business investment and innovation. First of all, let's discuss about the CGT tax reforms. Now, this is a really critical. From 1st July 2027, the 50% of the CGT discount will be replaced with cost-based indexation or assets held longer than 12 months alongside a minimum 30% tax on the net capital gains. The changes will apply to individuals, trust, and partnership and will apply even to assets that were previously treated as a pre-CGT exempt assets. Transactional rules will ensure that existing accrued gains remain subject to the current discount provided that they arose prior to 1st July 2027. So that's an important date. If you received a capital gains before the 1st July 2027, the rules remain the same for you. Investors in new build residential property may elect to continue the access to the current CGT discount. So the CGT discount has been limited now. You basically don't get that 50% discount for the established homes. So if you're invested in establishing homes, you may need to reconsider the strategy and you may need to look at now buying the new residential properties. Now the question here is, what about the commercial properties? We will discuss that later on. Now the second proposal which has been, or tax reform which has been implemented by the government, is negating the negative gearing changes. From 1st July 2027, deductions for losses from established residential properties will be quarantined to the rental income and future capital gains from the residential property. Excess losses will be able to be carried forward. These changes apply to properties acquired before 7:30 p.m. Australian Eastern Standard Time on 12th of May 2026 with existing investments grandfathered. So essentially negative gearing will not have an impact to you if you already have the proper property, whether it's established or the new. So you continue to get the negative gearing. But if you're looking at now the new proposal, which says that established homes, you will not be able to get the negative gearing. So that's an important part to understand here. Another important thing is that they have introduced a minimum tax on the discretionary trust. Now, what does that mean? For many of you, you probably would have seen the existing structure of the tax planning, which has been introduced by the tax specialists for over a decade or probably 2 decades, is that you have a trading entity which runs the business, and then that business is basically owned by a family trust, and in the family trust you have a corporate beneficiary. Now the setback because of the new rules are, the moment the family discretionary trust distribute any of the trust distribution to any of the beneficiaries down, there is a flat 30% tax on that. And another disadvantage is that if you have a corporate beneficiary in the family trust, discretionary trust, you don't get any franking credits. So essentially, I will say the bucket company structure is dead. We really need to think innovatively. We really need to digest these new laws. And I highly encourage you guys to seek an advice from the tax specialist, not the normal accountants, because these laws are complex. You need to understand how you can have now optimal tax structuring with these new rules which has been placed now. So another thing here is that these measures, or I'll probably say the measure about the minimum tax on the discretionary trust, includes targeted exclusions for certain type of trusts and classes of income, as well as transactional rollover relief to facilitate restructuring out of the discretionary trust. So what's important for you guys is, guys, talk to your accountant, talk to the tax specialist right now. If you have a business or tax structure that involved a family trust, you need to revisit that structure right now, because there are a temporary time period the ATO has given or the government has given where you could move out of the discretionary trust, perhaps to the unit trust or to the company. And there are some small business rollovers available for that, and therefore you would not incur any capital gain as of now. You may be able to defer it. So talk to your advisors right now if you ever had a family discretionary trust in your business or investment structure. Another, I think that's a good news, at least, is that $20,000 instant asset write off now has become a permanent feature from 1st July 2026 for businesses with turnover up to 10 million, allowing them immediate deduction of eligible depreciation assets below the threshold and continued pooling of high value assets. What does that mean here is that if you're buying a particular equipment in running your business which has a value less than 20,000, you can immediately claim that as a deduction. You don't need to claim a depreciation, if I say, over the useful life of an asset. You can just claim it in an immediate tax deduction in one particular year. Another good news I want to discuss with you is about the R&D T, which is your research and development tax incentive reform. From 1st July 2028, changes will made to eligibility rules and concessions setting on the R&D tax incentive aimed at improving integrity, how the incentive is targeted, and alignment with the broader innovation policy objectives. Another good news I want to share with you is the loss carryback measure. Loss carryback provisions will be reintroduced to support cash flow for companies with turnover less than $1 billion, alongside a staged introduction of loss refundability for startups to incentivize new business investments. I know a lot of people are talking about the negative side of the budget, but sometimes it is always important to also look at the positive side of the budgets. It's better than nothing. So I always say be optimistic, take a deep breath, discuss with your tax specialist. There is always a way to do a proper optimal tax restructuring. Now, coming to the individuals, if you're hearing me and you're an individual, you're not running a business, here's a good news that there are personal income tax cuts. The marginal tax rate from 18,200 to 45,000 bracket will be reduced from 1st July 2026 from 16% to 15% and then to 14% from 1st July 2027. I think that's a good news for the individuals. Now, the government has also introduced a 250 annual non-refundable tax offset, which will apply from 1st July 2027 to income derived from work, increasing the effective tax-free threshold for eligible taxpayers. I've already discussed about the instant tax deduction of 20,000. Now, EV, electric vehicles, are so popular right now because of the rising fuel cost. What is the government announcement on the EV side of things? The current exemption for eligible electric vehicles will be replaced by 25% FBT concession from 1 April 2029, implemented via 15% statutory rate with transitional arrangements, preserving existing benefits for early arrangements. So perhaps may not be that great news, but if you're in the market looking for an EV vehicle, perhaps to buy it now rather than deferring later on because they're going to cut the FBT exemption. Now, there are some corporate and international changes. I'm not sure the audience here will be that much keen to understand. But irrespective of that, I just give a very broad heading. So there are some law reforms for foreign residents CGT regime. So if you're a foreign resident of Australia and you've invested into a shares or property in Australia, there are some changes. Also, Pillar 2, global minimum tax rate. Amendments to the Australian global and domestic minimum tax rules will implement the OECD G20 side-by-side package from 1st January 2026, ensuring alignment with international developments and maintaining consistency with other jurisdictions. Now, federal government in their budget have introduced a number of significant tax measures, particularly in relation to our capital taxation, housing, business taxation settings. Many of these changes represent a notable shift in the long-standing policy settings and will have material implications for taxpayers and their advisors. However, while these measures are substantial, they do not, in my view, constitute a coordinated or holistic tax reform package. The announced measures are largely targeted at specific policy objectives, including housing supply, perceived tax mischief in the use of trust structures, and somewhat shifting the revenue burden from one sector, which is the labor income, to another, which is investment, rather than forming a part of broader integrated reform framework. The reforms to the CGT, negative gearing, and discretionary trust represent significant changes to the taxation of capital and investment. These measures are likely to influence investment behavior and may alter the relative attractiveness of different asset classes and choice of entity structure. However, they do not address broader structural changes within the tax system, including the over reliance on personal income tax, the impact on bracket creep, and increasing complexity arising from layered, concession tied systems and specific integrity rules. In absence of clearly articulated long term vision for reform, there is a real risk that these changes only do not go far enough to achieve their stated policy objectives, but also further fragment and complicate the system. The more coordinated approach to reform, including careful consideration of how isolated measures interact, is crucial to ensure the policy objectives are achieved without creating unintended consequences or additional compliance burden. Now, there are a number of changes which we were expecting the government may introduce, but they haven't. So, the introduction of new measures alongside a black backlog of announced but unenacted measures further contributes to the overall complexity of the system and reinforces the need for timely legislative process and clearer prioritization of reform initiatives. Looking ahead, you will see that the federal budget 2026-2027 introduced significant measures but leaves key structural issues within the tax system unresolved. For practitioners in coming weeks and months, the focus will be understanding the detail, particularly when it comes to the changes around the CGT discount, trust taxation, and negative gearing, and managing the impact of the transitional rules and future commencement date. What is important here is, guys, that if you have any questions right now, you can put it in a comment. I'm more than happy to answer. Of course, it's going to be a general advice. It wouldn't be a specific advice. What is important here is that we need to manage our expectations moving forward. If you're an investor in the market, either investing into property or through shares, EFTs, or gold or bullion or even silver, you may need to reconsider about your structuring. Should we go under the company? Should we go under the unit trust? How better you can save your tax? All these questions can be answered by your tax advisor and also by your tax specialist. What is important here is that we will always have a close eye, and I perhaps will say it is important that we always keep informed about the changes which is going to happen or have happened right now. I encourage my viewers and the people who are listening, do not panic. There are a lot of things happening in the world. there is a war in the Middle East, we are still better off with many people out there. What is important right now for us is to essentially think, reflect, pause, and understand these changes, how they have impact on yourself. This is not a time to be panicked. This is a time to seek advice from the wise tax advisors. What is important here as well is that while there are good news about the personal income tax cuts, there are some sort of a significant issues which has been raised is that whole mindset of the government has been that the changes to the CGT, negative gearing, and even the distribution of income through the distributionary trust are made only because they want to make sure that the young Australians in Australia will have the opportunity to buy their first home buyers. The irony here is that they have said that it will only able to get 75,000 people in Australia to get their first home buyers. Now my question is critically thinking is that we are a population of approximately 25 million in Australia. If these changes are going to help only 75,000 people in Australia, should we have done better? Should we have given a subsidy to these specific individuals, more targeted support rather than a blanket change of the tax reform, which is going to impact a lot of individuals, business owners, SME market? I'll leave these questions to you to think over because these are important questions to be asked. Again, I'm not pro or against the labor, but my thing is that these policies are to lure the voters, the young voters, towards them in the upcoming elections. Again, this is a thought for you to think about. Another issue here is that a lot of clients have contacted me over the last 2 days and said, Sabi, what should we do? Should we move our structure to Singapore? Should we move our structure to Cayman Islands? Should we, as a physically, if we are believe in building a wealth, then should we stay in Australia? Now that's your choice, of course, but it is good to understand the international tax base where they are. International, if you look at internationally, a lot of people move around, especially if they are in the IT space. For example, if you're running a business and your business is dependent on scaling your software as services, professional services. We need to be careful if you start thinking about moving physically to different country, maybe Middle East, maybe Singapore, maybe somewhere else in Europe. I think what it is important for you to understand the residency rules for an individual, for a company, and also to understand your ties back to Australia. Now, over the years, there are a lot of case laws which essentially, even if the people have moved overseas, have made them Australian resident for taxation purposes because their ties with Australia are strong. When I say ties in Australia, which means that you could have a family home there, you could have a children still in Australia, you're working overseas, and all these facts needs to be considered. I highly encourage my viewers and listeners, don't be reactive. Be proactive is good. Read through these tax reforms yourself, try to understand them, do some legal research. Do not get caught with the influencers on social media who are not accredited tax agents, who are not financial planners. Over last 2 days, I have seen significant people suddenly becoming a CGT expert, property expert advisors, tax advisors who have no accredited license. There is no way they can tell you what to do. So I think it is important you guys to be careful about the advice. My request is that these three critical significant changes are going to impact on you in some shape or form. Now, one of my client asked me other days, I said, you know what, Sabi, I'm going to increase the rent for my apartment or residential building or residential house because I'm going to keep it hold for a long time. Well, that's another ripple effect of these laws. People are going to increase, or the landlord going to increase the rent. What about the tenants? The tenants who can't afford to buy a home, what is the impact on them? So overall, if I look at economically as in economics, micro or macroeconomics, it does not make sense to me. Many of the professionals in the field as we speak have actually said to me, Sabi, who are the advisors to the government? Again, I'm not pro, I'm not against. I'll leave it for you guys to think about that. But what is important from this budget is that, again, comes into my mind is that in Australia, there is a real fear and there is a real thing about tall poppy syndrome. What is a tall poppy syndrome? For those who don't aware in Australia, the celebrities, Hugh Jackman himself has said that when he feels coming back to Australia from US, he feels people are not happy. Because somehow in Australian mindset, the culture is they don't feel happy when someone else is growing their wealth by working so hard. Is this the mindset in Australia? Should we change that mindset? Why we need to have a tall poppy syndrome in Australia? Should the government should intervene and help businesses to grow, help people to invest? Again, there are a lot of young people who have called me and they said, Sabi, what things we have done wrong? I, over the last few years, saved my salary, invested into shares, into property, and now suddenly you're talking about the negative gearing is gone. Suddenly you're thinking about the 50% on CGT is gone. I think the problem here is if now people are thinking about investing into business, thinking innovatively, is the government is discouraging them not to work hard. Because the moment you start scaling, start working more, well, you end up paying more tax. I've seen a lot of medical surgeons, dentists, GPs who are my clients, and they say to me, Sebi, what is the advantage of us working 5 days a week in Australia when we have to pay more than 47 cents per dollar after certain income? To be honest, I don't have an answer. And with this closing of discretionary trust, the tax of 30%, I think it is literally a fire. It's going to impact a lot of sole traders, high wealth individuals, but also the people like you and I, middle class Australians who are working every day so hard to put the food on the table for our kids, the wealth creation. Guys, I really want you to take this whole, if you've been with me since 12 noon, for last 30 minutes, I have discussed a lot of different tax reforms. If you need any specific guidance, any help, you are more than happy to reach me through my phone number, which is 0433426026, or you can email us on hello@sabypartners.au, or you can visit us in Melbourne CBD, level 27 101 Collins Street. We're also going to have an office in Gold Coast, and sooner than later, we will open another one in Sydney. So, with your all support and love and affection, I really want to say thank you for listening this budget debrief with me, giving me an opportunity to share my personal views and a journal discussion. If you haven't watched me live, this will stay recorded. Feel free to please jump on board and listen to the budget. If you have no more questions or comments, I'll probably pause here for a couple of minutes and see if you have any comments you won't like me to answer. Okay, guys, at the end, I just want to say to you guys, best wishes, stay strong, don't be overreactive, consult your accountants or advisors, and if you need my help, feel free to contact us anytime. Until next time, this is Saby, your trusted tax advisor from sabypartners.au. Take care.